Money, as we understand it today, is an essential component of modern economies and societies. Its invention and evolution have played a pivotal role in shaping human civilization. This essay delves into the reasons behind the invention of money, its historical development, and its impact on societies across different periods. The barter system, predecessor to money. Before the invention of money, ancient economies relied on a barter system. In this system, goods and services were exchanged directly for other goods and services without the use of a medium of exchange. While barter facilitated trade and economic activity, it had significant limitations. Limitations of the barter system. Double coincidence of wants. For a barter transaction to occur, both parties needed to want what the other had to offer. This double coincidence of wants was often difficult to achieve, limiting the scope of trade. Indivisibility of goods. Some goods were not easily divisible. For example, it was challenging to divide a live animal or a large item into smaller, tradable portions without losing value. Lack of standardized value. In a barter system, there was no standardized measure of value. The worth of goods and services was subjective and varied from person to person and place to place. Storage and perishability. Many goods were perishable or difficult to store for long periods, making it hard to save wealth or plan for the future. These limitations hindered the growth of early economies and necessitated the development of a more efficient system of exchange. Emergence of proto-money. To overcome the limitations of barter, ancient societies began to use items that had intrinsic value as a medium of exchange. These items, known as proto-money, included commodities that were widely accepted and valued for their utility, rarity, or aesthetic appeal. Examples of proto-money. Shells. Cowrie shells were used as money in various cultures, including ancient China, Africa, and the Indian Ocean region. Their small size, durability, and attractiveness made them a convenient medium of exchange. Metal objects. Metal items such as bronze, copper, and iron tools or ingots were used as proto-money in many early civilizations. Metal was valuable for its durability and utility in making tools and weapons. Livestock. Livestock, such as cattle and sheep, were used as a form of money in pastoral societies. Livestock had intrinsic value as sources of food, labor, and clothing. Grain. In agricultural societies, grain was a common form of proto-money. It was a staple food, could be stored for future use, and had a widely recognized value. While proto-money facilitated trade and economic activity, it still had limitations, particularly in terms of divisibility, portability, and standardization. These limitations eventually led to the invention of coinage. The invention of coinage. The invention of coinage marked a significant milestone in the history of money. Coins provided a standardized, portable, and durable medium of exchange that facilitated trade and economic growth. Origins of coinage. The first coins were minted in the ancient kingdom of Lydia, located in present-day Turkey, around 600 BCE. The Lydian king Croesus is often credited with standardizing the production of coins made from electrum, a naturally occurring alloy of gold and silver. Characteristics of early coins. Standardized weight and purity. Early coins were stamped with a mark indicating their weight and purity, providing a standardized measure of value. Durability. Made of metal, coins were durable and resistant to wear and tear, making them suitable for repeated use. Portability. Coins were small and portable, making them convenient for trade and commerce. Divisibility. Coins could be produced in various denominations, allowing for precise transactions. The invention of coinage revolutionized trade and commerce, enabling the development of more complex and interconnected economies. The spread of coinage. The concept of coinage quickly spread from Lydia to other parts of the ancient world. Greek city-states, the Persian Empire, and the Roman Republic all adopted coinage, each contributing to its evolution. Greek coinage. The Greeks began minting their own coins around the 7th century BCE. Greek coins, often made of silver, featured intricate designs and inscriptions. The use of coinage facilitated trade within and between Greek city-states, promoting economic integration and cultural exchange. Persian coinage. The Persian Empire, under King Darius I, introduced the gold daric and the silver siglos around 500 BCE. These coins, minted to high standards of weight and purity, were used throughout the vast Persian Empire, facilitating trade and taxation. Roman coinage. The Romans adopted coinage around the 4th century BCE. Roman coins, made of gold, silver, and bronze, featured images of emperors and symbols of Roman power. The widespread use of Roman coinage helped unify the diverse regions of the Roman Empire and facilitated trade across Europe, the Middle East, and North Africa. Paper money and banknotes. While coins remained the dominant form of money for many centuries, the invention of paper money marked another significant development in the history of money. Origins of paper money. Paper money originated in China during the Tang dynasty, 618 to 907 CE, and became more widespread during the Song dynasty, 960 to 1279 CE. The Chinese government issued paper notes, known as jiaozi, as a means of facilitating trade and reducing the need to carry heavy metal coins. Spread of paper money. The concept of paper money spread to the Islamic world and Europe through trade and exploration. In the medieval Islamic world, merchants used bills of exchange to conduct long-distance trade, reducing the risks associated with carrying large amounts of coinage. In Europe, the first recorded use of banknotes was in Sweden in the 17th century. The Bank of Sweden issued paper notes as a means of providing a more convenient and secure form of money. Other European countries soon followed suit, and by the 18th century, paper money had become a common feature of European economies. The development of banking systems. The evolution of money was closely tied to the development of banking systems. Banks played a crucial role in facilitating trade, providing credit, and managing the money supply. Early banking systems. Early banking systems emerged in ancient Mesopotamia, Greece, and Rome. Temples and palaces acted as proto-banks, accepting deposits, making loans, and facilitating trade. Private moneylenders also operated, providing credit to merchants and traders. Medieval and Renaissance banking. During the medieval period, banking activity increased, particularly in Italy. Italian city-states such as Venice, Florence, and Genoa became centers of banking and finance. Prominent banking families, such as the Medici, played a crucial role in financing trade, industry, and political activities. The development of double-entry bookkeeping, a system that allowed for more accurate tracking of financial transactions, further advanced the practice of banking. This innovation, credited to the Italian mathematician Luca Pacioli, became a standard practice in European banking. Modern banking systems. The modern banking system began to take shape in the 17th and 18th centuries with the establishment of central banks. The Bank of England, founded in 1694, was one of the first central banks and played a key role in managing the money supply and stabilizing the economy. Central banks issued banknotes, regulated the banking sector, and acted as lenders of last resort. The establishment of central banks contributed to the stability and growth of modern economies. The gold standard. The gold standard was a monetary system in which the value of a country's currency was directly linked to a specific amount of gold. This system aimed to provide a stable and predictable monetary framework for international trade and investment. Origins and adoption. The gold standard was first adopted by the United Kingdom in 1821. Other countries followed, and by the late 19th century, the gold standard had become the dominant monetary system worldwide. Benefits and challenges. The gold standard provided several benefits, including stability. The gold standard provided a stable value for currency, reducing inflation and promoting confidence in the monetary system. Predictability. Fixed exchange rates under the gold standard facilitated international trade and investment by reducing currency risk. Discipline. The gold standard imposed fiscal discipline on governments, as they could not easily increase the money supply without corresponding gold reserves. However, the gold standard also had significant challenges. Rigidity. The fixed nature of the gold standard limited governments' ability to respond to economic crises and adjust monetary policy. Deflationary pressure. The gold standard could lead to deflation, particularly during periods of economic downturn, as the money supply contracted with declining gold reserves. Decline of the gold standard. The gold standard began to decline in the early 20th century, particularly during the economic turmoil of the Great Depression. Many countries abandoned the gold standard to pursue more flexible monetary policies. The final blow to the gold standard came in 1971 when the United States, under President Richard Nixon, suspended the convertibility of the US dollar into gold. This move effectively ended the gold standard and ushered in the era of fiat money. Fiat money. Fiat money is currency that has no intrinsic value but is established as legal tender by government decree. Unlike commodity money, which is backed by physical assets such as gold or silver, fiat money derives its value from the trust and confidence of the people who use it. Advantages of fiat money. Flexibility. Fiat money allows governments and central banks to implement flexible monetary policies, adjusting the money supply to meet economic needs. Control. Central banks can manage inflation, interest rates, and economic growth more effectively with fiat money. Convenience. Fiat money is easy to produce and distribute, making it practical for everyday transactions and digital payments. Challenges of fiat money. Inflation risk. Fiat money can lead to inflation if governments print excessive amounts of currency without corresponding economic growth. Trust dependency. The value of fiat money relies heavily on public trust in the government and central banks' ability to manage the economy effectively. Debt and deficit. Governments may be tempted to finance deficits and debt through the printing of money, leading to potential long-term economic instability. The evolution of digital money. As technology continues to advance, the concept of money is evolving further into the digital realm. Digital money, including cryptocurrencies and central bank digital currencies, CBDCs, represents the latest stage in the history of money. Cryptocurrencies. Cryptocurrencies like Bitcoin, Ethereum, and many others are digital assets that use cryptographic techniques to secure transactions and control the creation of new units. They operate on decentralized networks using blockchain technology. Advantages of cryptocurrencies. Decentralization. Cryptocurrencies are not controlled by any central authority, reducing the risk of government manipulation. Security. Blockchain technology provides a high level of security and transparency for transactions. Global access. Cryptocurrencies can be used across borders, facilitating international trade and financial inclusion. Challenges of cryptocurrencies. Volatility. Cryptocurrencies are known for their price volatility, which can make them less stable as a store of value. Regulation. Governments and regulatory bodies are still grappling with how to regulate and oversee the use of cryptocurrencies. Adoption. While growing, the acceptance of cryptocurrencies as a mainstream form of payment is still limited. Central bank digital currencies, CBDCs. CBDCs are digital versions of a country's fiat currency, issued and regulated by the central bank. They aim to combine the benefits of digital transactions with the stability and oversight of traditional fiat currencies. Advantages of CBDCs. Stability. CBDCs are backed by the central bank, providing stability and trust similar to traditional fiat money. Efficiency. Digital currencies can streamline payment systems, reduce transaction costs, and improve the speed of transactions. Financial inclusion. CBDCs can enhance financial inclusion by providing access to digital financial services for unbanked populations. Challenges of CBDCs. Privacy concerns. Digital currencies raise concerns about data privacy and the potential for government surveillance of financial transactions. Technological infrastructure. Implementing CBDCs requires robust technological infrastructure and cybersecurity measures. Transition. Shifting from traditional money to CBDCs involves significant changes in financial systems and public adoption. The role of money in society. Throughout history, money has played a crucial role in shaping societies, economies, and cultures. Its evolution reflects the changing needs and complexities of human civilization. Facilitating trade and commerce. Money simplifies transactions by providing a common medium of exchange. It eliminates the inefficiencies of barter and allows for the exchange of goods and services across vast distances and diverse communities. Storing value. Money serves as a store of value, allowing individuals and societies to save and accumulate wealth. This function supports investment, economic growth, and the ability to plan for the future. Unit of account. Money provides a standard measure of value, making it easier to compare prices and value goods and services. This standardization is essential for economic decision-making and record-keeping. Social and cultural impact. Money influences social structures, power dynamics, and cultural practices. It shapes economic hierarchies, access to resources, and societal norms related to wealth and status. The invention and evolution of money have been driven by the need to facilitate trade, store value, and provide a standardized measure of worth. From barter and proto-money to coinage, paper money, and digital currencies, each stage in the history of money reflects the changing complexities of human societies and economies. As we move further into the digital age, the concept of money continues to evolve. The emergence of cryptocurrencies and central bank digital currencies represents the latest chapter in this ongoing story. These developments offer new opportunities and challenges, highlighting the importance of trust, stability, and technological innovation in the future of money. Understanding the history of money provides valuable insights into the economic and social forces that shape our world. It reminds us that money is not just a tool for transactions but a fundamental element of human civilization that reflects our collective values, priorities, and aspirations. As we navigate the future, the evolution of money will continue to play a pivotal role in shaping the trajectory of societies and economies worldwide.